So good afternoon, everyone. My name is Marie Brière. I am the scientific director of the FaIR program, so Finance and Insurance Reloaded program at Institut Louis Bachelier. And it is my great pleasure to welcome you for this webinar on alternative data use in asset management. So with the recent advances in data analytics, we now have access to large and complex data sets like consumer transaction data, retail investment volumes, web traffic, media or social media, satellite imagery, etc. And all this data allows to trace point-in-time information on individuals and businesses' activities with a lot of potential investment applications. Asset managers and hedge funds have been estimated to invest heavily into alternative data, and this will continue to grow, in particular, due to the increasing need of ESG data. Alternative data brings new insights, but they also suffer from some limitations. They lack depth, they can suffer from selection bias. In this webinar, we intend to discuss real use case of alternative data by asset managers and discuss what is their value added for investment, but also what are their potential biases and how should their due diligence be done? And finally, how do they impact market efficiency? So to discuss this, we have the chance to welcome today two distinguished guest speakers. I will start with Alexander Denef, former head of AI, financial services and risk advisory at Deloitte, lecturer in mathematical finance at the University of Oxford. Alex is one of the key specialists in alternative data. He's the author of a bestseller, the Book of Alternative Data. And Alex will provide real-world examples of alternative data usage, how to analyze them, how to integrate data flows within existing systems. Ronnie Sadka will follow. Ronnie is professor at Boston College. He's a very well-known academic, a great specialist of market liquidity, and recently he has been developing big data-driven investment applications from consumer media data, etc. He's the founder of MKT Media Stats, which is an academic partner of State Street Associates. These presentations will be followed by a roundtable discussion with key professionals in this field and moderated by Charles-Albert Lehal, who is the global head of quant research and development at ADIA, the Abu Dhabi Sovereign Wealth Fund. So please don't hesitate to make this event interactive by raising your hand or using the chat function. And I would like to mention that this event is very special because it is the first time we organize it in partnership with Association Française de Gestion. And I have the great pleasure to introduce Guillaume Simon, who is a research manager at CFM, a French famous hedge fund, and chairman of the Club of Quant Techniques at AFG. And also Adina Gouraud-Dibert, who is the head of asset management at AFG, who are the co-organizers of this event. And I would like to warmly thank them for that, and also all the members of the Quant Technique clubs. I also would like to mention that Institut Louis Bachelier is jointly organizing with ACPR a series of conferences on digitalization. So we had one in September on deep learning, one in December on cyber risk. We will have a new one on DeFi in a couple of months. So please check the program if you're interested on our new website. And I would like to congratulate ELB team for that. I think that Feriel will give you the website in the chat. And before I leave the floor to Guillaume for a few words, I would like to thank my partners at ELB, Louis Bertouchy, who is the scientific coordinator of the FaIR program, and ELB's team, Stine, Feriel, Miriam, and Natalia. So with that, Guillaume, the floor is yours.
Thank you, Marie. So I will be very brief. Yes, just a few words to explain you the context of this event. A few years ago, we started to set up a club called Quantitative Techniques in Asset Management for the AFG, Association Française de Gestion, that we may translate in a kind of French asset management association or lobby. And for years and years, we have been doing this club among the members of the IFG. And the focus was to invite professionals to speak with academics that were presenting their papers, and just to induce a discussion between academics and financial professional. the kind of topics we addressed have been, for instance, factors, macro factors, ESG, green bonds, or also the partnerships between research, academic research, and asset managers or hedge funds. So here I'm working for CFM, and I'm speaking on behalf of the IFG. So it's really the first time that we mix the two audiences, the people that are more accustomed to, I would say, IFG or those quant clubs, and also people coming after having the invitation from the ELB. So I would like to briefly to thank both institutions, IFG, so Adina and Charlotte, of course, and also ELB, FaIR, and all the organization team at the IFG. So without further ado, I will leave the floor to the speaker, and I think that Alexander will be starting. So thank you for your talk today, and also to all the people that will attend to this event.
Okay. Thank you very much, Marie. Thank you very much, Guillaume. Thanks also to the Institute Louis Bachier and IFG for giving the floor for this presentation to me today. Let me share my screen. And I hope you'll be able to see it. Yes, can you see it?
Yes, now we can see
Okay,
it.
great. Okay. Today I want to speak about alternative data, not just about, show that there are signals in alternative data, because if you're smart enough to find the right data set, and this comes from experience, you will find a signal, okay? And this signal is tradable. But there are a lot of difficulties when it comes to using this signal in production. So from theory to running a model, calibrating, doing your backtesting strategy on paper, maybe in a live system as well, paper trading, to fully fledged use of alternative data in production, there are many steps and many missteps. And when I look at the landscape of funds, asset managers that try to use alternative data, many initiatives actually failed, not because of the lack of signals, but because they didn't know how to set up the target operating model, the talent and the technology behind this. I'll give an overview of what are the difficulties. If there is time, as Marie mentioned, I can give some examples, but I would like to center the talk on the problems that we're encountering in alternative data space. I'll start with some subliminal messages. This is my book with Said. It's available on Amazon. It's called the Book of Alternative Data, so it's self-explanatory. It's roughly divided in two parts. The first part is theory introduction, legal aspects of alternative data, technology, and so on, while the second part is examples, so roughly two parts. So, but what is alternative data? Would you mute your microphone? Somebody's having the microphone turned on. Yeah.
Mais effectivement, ça peut être compliqué.
Okay, thank you. So what is alternative data? In the book, Sid and I, we define some properties of alternative data. What makes alternative data alternative? It's less common use by market participants. On average, tends to be more expensive, often outside financial markets, but not only. We consider, for example, high-frequency tick data, or also alternative data. In general, it has shorter history, which creates a problem, and it's more challenging to use. And I'll show why this happens, what methods we need to deal with alternative data. Most of the time, the alternative data that we can purchase in the market is exhaust data, so a byproduct of other processes. So if you think about credit card transactions, of course, credit card companies have been operating for quite some time now. Their main activity is, of course, transactions, but they store the data of these transactions, and they can monetize this data. So most of the data is coming from corporates is exhaust data. So there are two conversations here. I'll focus on the asset management use case, but there is also conversation with data vendors. And many companies sit on data which they're not aware of. So the question is how they can monetize this data in financial markets. And this often are big corporates who do not operate in financial markets, but nevertheless, they have assets. So there is a conversation there with the chief data officer of these institutions, but I'll take the buy side point of view in this talk. Actually, yeah, let me put full screen. Yeah, you all heard about the V's of big data, but they apply to alternative data. But I must highlight here that alternative data is not necessarily big data. We have many examples of alternative data that's small sample, actually. Many V's, there are around 10. I think 7 are important. What applies to alternative data that doesn't apply to more traditional financial data? So volume, of course, there is a lot more data now. The volume is increasing. This applies to traditional data as well. What is interesting in alternative data space is the variety. So we have many more diverse data set. It's not just time series numerical data that you can download from Bloomberg, it can be unstructured data, so text, images, video. Also the velocity at which it is generated and distributed, it's higher. What is typical for the alternative data world is the variability. So there are many more inconsistency in alternative data space. Of course, we can find inconsistencies also in macroeconomic time series, but in alternative data, this problem is further augmented. There be inconsistency because data is not collected properly, or inherent inconsistencies, missing data, for example. So if you take satellite images, if they're clouds, you can't see through the clouds, at least with some of the most widespread methodologies. So there are some inherent limitations and inconsistency in the data. And of course, also it's important to highlight that how this data is delivered can be subject to variability. And this depends very much on your relationship with the data vendor, it depends on the infrastructure of this data vendor, how it delivers the data, whether there are some controls in the process of delivering data. So what we see in alternative data space is that variability is increased. Veracity in general is decreasing. We can't tell if this data is really accurate. You know, it boils down again to third-party risk. Are we sure that we're buying the right data, or we might be buying synthetic data sets? Social media data, fake news, or also some inherent physical limitations. If you could take GPS data, it is not very accurate in between buildings. So there are also physical limitations that make the data non-accurate in certain circumstances. And the business of value of data with alternative data, we believe is increasing. So in the book, we proved with many examples that indeed there is value in alternative data. It adds value to trading strategies. Here are some examples of alternative data: satellite, location data, text, consumer transactions, corporate. And now everybody's speaking about inflation in supply chain. Supply chain data is becoming more and more important. Market data, as I mentioned before, so financial data can be considered alternative data if it's high frequency. And crowdsourced data, which is usually not big data, but nevertheless is collected through means that are considered non-alternative. In this case, can be scouts on the ground, analyst estimates. Okay, so it's really a broad universe of data, and every day we see some new data sets appearing and another data set disappearing, sadly, which further complicates, of course, how we deal with alternative data. So it can be big data, as I mentioned before, but sometimes you can deal with one data point only. Okay, especially discretionary investors, they don't aim to get statistical accuracy after many repetitions of certain variables in the data set, but they just want to have one-off information on what's going on. Classical examples: these 3 hedge funds. You see here they greatly benefited from alternative data. The rumor says that they have tracked Johnson & Johnson private jet landing near Actelion, and the merger followed, and these 3 hedge funds made more than 300 million. So this is just one data point. They haven't built any quantitative model. but nevertheless, alternative data can be very insightful in these cases. Many cases here, I here provide the references. If you get the presentation after the talk, you can check these references down the bottom left of the slide. But I'll give some example. Online price and inflation. I here mentioned global FSI firm employs technology to track 5 million products online. You can guess this is price stats actually, recently sold to State Street, but they scrape data from web. They check how prices increases from online retailers, and they can provide the nowcasting, not a forecasting, but nowcasting of inflation before the official number.
Alexander, excuse me, your micro is
We cannot
off.
hear you.
Your micro, can you put it back?
Okay, yes, sorry. Can you hear me?
Yes, thank you.
Yeah.
Sorry for that.
I don't know what part you missed. I was explaining that.
We left you when you were describing price stats.
Okay. You know, I was saying the US number came in today about inflation above expectations, which moved the markets initially quite a lot. So it's very important to get these estimates. And, you know, if the differential is that big as we saw today, it's quite a market edge. Another hedge fund, I give the examples here. You can read the reference. It's a combination of data. So sometimes value lies not just using one data set, but by using intersection of different data sets. So these hedge funds uses credit card transaction, geolocation, and app downloads to analyze burger chain performance. This is another example, but where we can see interaction. The other one is social media and search to predict corporate earnings. You know, this is somehow already overloaded. There are many startups who provide services in this space. Mobile food traffic to understand the state of the economy. Another example I can give here from personal experience is using air pollution data. And air pollution data is free. It's available every hour around the globe. You can understand economic activity. You can understand mobility. Okay, you can understand what kind of fuels are burned at the moment by just using the chemicals that are emitted in the air. Okay. Another example is another hedge fund using satellite intelligence on ships and tank movements. Here, the AI system comes to mind, which is a system that allows tracking ships around the world. But again, if you remember what I said before about variability, reliability as well on the data, this sometimes is not reliable. And what we are noticing now through this AI system is that the Chinese ships, they tend to turn off their AIS trackers. Okay, so they don't want to be tracked. Okay, how do you deal with this problem? This is a big question. Or you can use web and Twitter, which is the last example, bottom right, to find to understand which reports are going to make it to the newswire, and of course, if they make it to the newswire, they'll hit the market. So what they call here the media food chain. Okay, there are many examples. You can see the sky's the limit in alternative data, and there's so many permutations. And people ask me, what is the danger of overcrowding? This is a big question now. Of course, if you find a way to combine in a unique way, unique data sets, and you do it before the market, you have the edge. Of course, we notice some overcrowding in certain data sets, especially web scrape data. But if you move fast, you can get the advantage in that. So who are the market players who needs this alternative data? We see different players ranging from very sophisticated quants, so systematic trading strategies, more traditional investors, still quant mindset, but they're a little bit behind the curve. They're less sophisticated, and they're just opening to the world of alternative data. We see also more traditional investors. These are the discretionary ones, and of course fintech. And there is a lot of business going fintech, who sometimes just buy data, aggregate data, extract signal from data, and they resell this data to the market. Each one comes with their unique needs and challenges. The list is too long to go through it, but to summarize it, there are challenges in technology, how you start incorporating this data. Who is going to do that? Do you have the right talent to do that? And how you can manage risk, how you can be sure that there is signal in the data before you start purchasing, investing in data. As I mentioned before, talent is a big problem in alternative data. So this is one of the barriers to entry, is how to organize a team to extract alternative data. So what's the target operating model? Okay, as I said before, you find a signal, but how to organize a factory, a signal factory to extract the signal. This is the art. Dia and Charobert are doing something very nice and that can exploit alternative data is the collaboration effort. Is it possible to have it? Yes or no? Collaboration is essential because alternative data can be, as I said, very diverse. You need different skill set. If you deal with pollution data, you have to understand a little bit of chemistry. If you deal with other types of data, you might need physical knowledge, geography, and so. So how to set up the right team is a big question. And of course, data scientists are very expensive. Here, give an example, the cost of running a team of alternative data team runs around between 1.5 and $2.5 million per year. These are New York prices. You need data engineer, data analyst, data scientist, a data scout, and I'll mention what it is, and head of data. So what are the challenges? There are a lot of legal questions, and we've seen some court cases around alternative data around the world, and they're very much geography dependent. So in Europe, we have, actually you have the UK is no longer part of Europe, so most probably we will deviate from GDPR, but in Europe, GDPR is the master regulation when it comes to privacy and protection of data. So there are limitations. You cannot sell raw data directly. You have to make sure that there is a certain level of blurring. And of course, this lies on the shoulder of data vendor. But you as a data buyer, you have to make sure that really you cannot reverse engineer any personal information. There are a lot of startups operating in the space of differential privacy that they blur the data, so you can't really reverse engineer personal information, and you can start using it. Exclusive data sets. So also some legal issues about data being sold exclusively to certain hedge funds who made a lot of money. One case I can recall was around Bank of England minutes, which were sent, I think, 2 years ago in advance to certain hedge funds, and they took advantage before the rest of the market. Okay. It's very important to be aware of the legal challenges. So there are a lot of data challenges. Entity matching. You'll be dealing with entities. If you extract information about entity from text, you have to recognize that entities, and it's very difficult because the entity can be spelled in really many different ways, but not only. An entity can have around 200 subsidiaries around the world, in different industry, financial, utilities, and so on. How you make sure that you really recognize the entity from text. So this is very relevant to equity trading. I shy away personally from equity trading. I deal more with forex trading, and in forex trading, life is easier because you don't need to have entity recognition and mapping. You just trade the macro risk, and you don't have these data challenges. As I said before, missing data can be sparse. Can be missing, there can be anomalies in the data, can be outliers, they can be due to how data is collected or some technical glitches. This comes especially if you use free data and you don't have any commercial relationship with the data vendor. They send you data, and I see it also in experience. I trade a lot of free data, but all of a sudden the data feed could disappear. And this data vendor, not vendor, but data supplier for free, they don't have any obligation to restore the data feed because it's free data. So there is no control over that data supplier. Structuring the data, a lot of alternative data comes with in a structured form, so you have to use methods to structure it, to make it usable. I think I have 2 minutes left. Marie, can I take a little bit more time? Because I think I need 10 minutes.
Yes.
You're
Yes,
fine
you
with
can
that?
take. Yes, you can take 10 minutes. It's all fine.
Okay, good. Okay, said before the data risks. Okay, and this is many of these things are new to alternative data. Space data provenance risk, accuracy risk, privacy risk, material non-public information. We have to be sure that we're not trading on insider information. Model risk, also in traditional world there is model risk, but here is augmented because you have models to also to extract features, so you have to be careful here. Talent risk, how you find and retain talent. Data scientists are in short supply, and how you hire and how you retain them, it's also a big problem. And some regulatory risk, we have some guidance coming from the Fed in the US with regards to the use of alternative data in credit risk space, not in investment management, but you know, I expect these regulations to start, or guidances to start popping up. When it comes to algorithms, what is new here? As I mentioned before, feature extractions, it requires novel algorithms that did not exist decades ago, few years ago. So for image processing, for example, convolutional neural networks, for text sound processing, recurrent neural networks, and so on. These are all novel tools that did not exist at the time, which, as I mentioned, introduce new risk, and you require a higher level of expertise compared to more traditional models. And when it comes to nowcasting and forecasting, what is new? Now we have to deal with many variables. Okay, each data source you start using, try to extract signal, comes with its own variables. So your data set increases and can increase exponentially. You have to deal with hundreds of variables. So I think what is most important in this case, instead of using sophisticated algorithms like neural networks, which are black boxes, okay, they can extract linearities, is to use simpler models on the right data sets. But simple, not that simple as a linear regression, because if you use many variables, you have to make sure that there's certain sparsity. You cannot select, especially if your history is very short, you cannot select 100 variables to explain a monthly time series of 10 years. So you have to use some algorithms that ensure sparsity. So this is the novelty in the big data world. I want to run quickly through an example. Nowcasting and forecasting, slightly different concepts, but they go hand in hand. I like this inflation example, so I'm focused on inflation modeling these months. But if you want to model inflation, for example, one period ahead, use certain variables like past lags of inflation, okay, expert consensus, which can be considered an alternative data set, okay, it's crowdsourced data, and you might want to use unemployment, okay, but unemployment is not available as of today. So if you want to make a prediction as of today of inflation, let's say 1 year ahead, you're missing some of the variables. How you can fill these variables? You can fill them with alternative data, and I give here the example. So you can build a model. These are probabilistic graphical models, but without delving into the details, essentially shows how probabilistic models are connected. You can use web scrape data, news on unemployment in this case, and you can predict nowcast unemployment in this time period, and you can feed it into your inflation model. And of course, on the top of the information that you can get about unemployment, web scrape data like sentiment can feed directly into a direct inflation forecast. So alternative data can be used for nowcasting to understand where the economy is now, before the official figure is released, but you can also use it in forecasting. Okay. So without going to many more examples, searching for alternative data, the hottest profession, as of today, I think, in alternative data space is the data scout. Okay, so a person who just tries to understand the data markets, goes after new data sets in the markets, researches these new data sets, and of course there is also the pricing aspect. I'll mention briefly. Earlier, everything starts with a hypothesis. You start from hypothesis. You think of a data set can add value. So what you have to of course, to try out these data sets. And many data vendors, they provide free trials. Some of them come also with white papers who already prove that there is a signal in the data. I will rush a little bit. I have very few minutes left, but where you can find data, you'll be surprised. There is a lot of free data. You can find it through web. This is how I find data. And you'll be surprised that that there are many data sets you haven't thought about. Data scouting and cataloging firms. So there are 3 firms at the moment who just scout and catalog data, and they don't own the data, but they can provide guidance. There is this website that's not used anymore, alternativedata.org. Or of course, other approaches to directly approach a data vendor. Tried in the past with corporate firms, but as I mentioned at the beginning, there are just awakening to the alternative data monetization in financial services space. So this can be challenging to approach a firm from scratch and ask for data. Yes, again, data strategies and scouts, very hot profession as of today. Cost of data. Another aspect of data is how would you price your data? It depends on many factors. In the book, Said and I give, I think, around 36 dimensions across which to price the data. It depends very much what kind of investor, what kind of firm you are. Asset coverage is important. If you're a systematic hedge fund, you need to have a broad coverage for your universe. This is why niche data sets are not of interest to systematic hedge funds, while discretionary investors, they want maybe to have a niche view on the data set. And also we are seeing private equity firms getting into alternative data sets. They're more and more interested on niche data sets. Depends on the frequency, how often you want to trade, once per month, every second. The uniqueness. Is it a monopolistic data set, or there are any similar data sets in the market? For example, when it comes to satellite images providers, we have quite good competition now. How can the cost be reduced? What we're seeing in hedge fund and asset managers, portfolio managers do not negotiate data directly with the data vendor. Everything goes through the chief data officer. Why is that? Because they can negotiate discounts. If there are more desks using certain data sets, of course, there is discount when more subscriptions are purchased from the data vendor. So what we see is centralization of this data negotiation and onboarding process. And let me show this last slide. I'm aware that I'm overrunning. So what are the steps? Here I put down 8 steps how you should approach alternative data if you want to start using in your institution. Of course, the first one is strategy and vision setting. Not many firms are yet convinced that they should be onboarded on this journey. So this conversation with the chief investment officer, with the CEO, but you can't go anywhere without any strategy in vision setting. The second one is to data requirements, find the relevant data set to inform the investment strategy. And of course, perform the cost benefit analysis of obtaining data. This is where free trials and white papers help to understand the value that it can add to your organization, given your style, investment strategy, and your portfolio position. Identify the source of data and perform due diligence. so third-party due diligence. A data vendor could disappear tomorrow, and without mentioning names, we have seen some example. Okay, third-party due diligence is important, as we're dealing here with thousands of data vendors rather than one data vendors. And many platforms they already due diligence, like Bloomberg, FactSec, and so on. So they perform this due diligence. Risk assessment mentioned before, privacy risk, financial, operational, regulatory, reputational, and technological. So is your technology stack able to cope up with the influx of data, especially if it's unstructured, if it's high volume? Implement controls around this, how the data flows into your architecture, how the signal is extracted, and so on. So this is the controls at the input of your modeling. Then develop models, incorporate models, which you can use in the production. Model risk increases here in alternative data space, because when you extract features, you have models, then you have your investment strategy. So you have a chain of models. So here, model risk increases. So one must be really careful in managing model risk. In the last point is performance monitoring, having a system in place to monitor the decay of the signal. And as I said before, a signal can decay because of two reasons. One is overcrowding. Too many people are using the data set. And second reason is because the signal itself decays in time. A new source can be relevant for a certain period of time, but can become irrelevant. Now 3 years ago, we didn't have any COVID information healthcare data. These have become really important data sets for the past 2 years, and most probably they're going to disappear in the future. So some data sets are transitory, also the supply chain, very hot topic, but is it going to persist? So you have to value really the risk that you're buying something that can be obsolete in few months, and the onboarding process of a data set can take several months. And I would conclude here. I want to give a couple of examples, of satellite images. But you can find this in the book, and also there are a lot of free examples on the web. So without delving into the technical details, I would stop here.
Thank you very much, Alex, for an impressive presentation and very comprehensive. It's very useful. So let me open the floor for a few questions. There is already one by Thierry Foucault, who is a specialist of alternative data, because a specialist of microstructure. And he's asking about the horizon of the signals in alternative data. At which speed do they decay? I think it's a great question, right? Because you mentioned that there are these data scouts looking for alternative data sources. So it's a kind of race to find new sources of information, because at some point they become incorporated into prices, and then you need to find alternative sources. So what's your view on the alpha decay in these types of signals? What's your experience in that? And Thierry, please feel free to complement or...
Thanks, Marie. That's exactly my question.
Yeah, very difficult to give one encompassing answer of the possibilities. The first line of defense, let's say this again, signal defense lies with the data scouts, and experience, what works and what doesn't. It comes, with years of work in that space. The second line, I would say, comes from the quants. So you really have to think when using this alternative data about causality. And Pierre later, I'm sure will mention something about causality, because this ensures the stability of signal in time. Are you looking for fundamental drivers, or you found maybe in a free trial that your signal is some spurious correlation, but you just want to use it? If you have a strategy like that, you're not generating stable signals. But of course, if you take new sentiment, can we argue that sentiment drives markets? Yes, it drives markets, of course. So it's there to stay. I'm confident that it's going to be a driver, whether it's going to be alpha, we don't know for how much time, how quick you are to exploit this and monetize it. And afterward, it will appear in the prices. No, it's going to be a beta. But what I say, it's not game over for you, because it's like Bloomberg data. Everybody has Bloomberg data, but you must have it. Otherwise, you won't get the beta out there. So yes, it's good to be quick, make the scouting smart, the model smart, get some alpha. But there are some data sources that, even overcrowded, they will be necessary for you to understand the economy. Otherwise, you're going to be left behind.
Thank you. We have a question from Mark, and I see also Guillaume is raising his hand. So Mark is asking about compliance. Is compliance typically involved in validating an alternative data source? What is a template of due diligence? And I had a related question. I think this is a really important question about also regulation. So what are the regulatory requirements for alternative data vendors? And also, I've been involved in discussion at ESMA about the risk of fragmentation of the processes. If you think that now an asset manager, for example, could be using an alternative data source and also an algorithm that is externally managed, and combining all that, there is also risk that the value chain becomes very fragmented, and who is responsible in the end? So do you have a view on that, compliance and regulation?
Yeah. I had conversation with compliance at least 1 year ago, and they just started awakening to. I had to teach them what alternative data is, but they started thinking about it. So at least 1 year ago, when it was my last conversation, they were not that much involved in that. But of course, things are going to change. So when it comes to regulations, they're not direct regulations, like they're not AI regulations in general, apart from the new one that's going to be introduced now. But tangentially, you can, cross-sectionally, you can find references that must be used in alternative data space, like GDPR impacts the usage of alternative data, MMPR, material non-public information, insider trading, all these regulations, they cross-sectionally impact alternative data. So, and the one I'm aware is, as I mentioned, the Federal Reserve credit risk alternative data guidance, but I haven't seen anything similar in investment manager space. So, of course, you have to comply with the other directives that I just mentioned. And with regards to the value chain, indeed, it becomes complicated, and you don't have to build everything yourself. So in the examples I mentioned here, so these models that I'm building now, I cannot scrape data personally. So I buy this web scrape data. So I have to manage third-party risk. And you see every circle here in this model diagram adds complexity. But even if you don't trade with model, if you want to create voice recognition software, so first you have to do speech to text, then you have to classify the text. So you already have two elements. And usually what I've seen is practice, people buy the first part. There are many free APIs or very low cost that they convert sound to text. And then you focus on where you can add value, which is the second part. So yeah, we see a lot of package solutions in alternative data space. It's like Lego pieces, that you combine, adding to complexity, and of course, and you need to risk manage all this.
Thank you, Alex. Guillaume, you had a question?
Yeah, it's more common because I think that the questions about performance or alpha decay are a bit, I would not say naive, but a bit linear, because what I think that the most realistic situation that happened is it's a one-off, like you have an alternative data and then it stops and then you throw it away, because you have all the cost, the historical cost of implementing it and having the data pipeline in-house. This is very costly. And so generally it's not a one-off, or it works, it does not work. And so in this situation where you see that the strategy you have implemented is maybe too naive, but 2 years later, after alpha decay, you have someone that can in-house recycle this data and do something new. And I think that this kind of situation is much more important and then problematic, because it's kind of fuzzy, and So it's not that because talking about alpha decay on an alternative data set means that you have a kind of a moving average applied on the signal, and that's all. So I think that the situation about performance monitoring, which is your last step, is much more complicated than just having a performance alpha decay and a one-off decision.
Thank you, Guillaume, for this comment. So I think we need to move to Ronnie's presentation. We're already running late. I saw the comment by Michel in the chat, and which is a perfect way to transition to the next presentation. Is asking about alternative data on ESG, and I think Ronnie, you will discuss that at least partly during your speech. So we can discuss that after your presentation. So if you want to share your slides, the floor is yours.
Hi, everyone. Can you see?
Not yet, but I guess it will come. No. Yes. Perfect.
All right. Great. Well, thanks, everyone. Thanks for EFG and the Institute Louis Bachelier for organizing this, Marie and all the committee members and my fellow speaker, Alex, and the panelists. This is, I'm very excited to be here and share with you some of my research. So a little bit, about myself. I'm a professor at BC, but I also founded this company called MKT Media Stats. And the sole purpose of this company is exactly bridging between technology and finance and offering some, alternative data-based solution. So I really like what Alex has said in his talk. I think it was a great introduction or summary of a lot of the issues that I actually confronted with myself. The being sure that the data is right, a lot of data issues, point in time, how do you use them for alpha, a lot of different things that I've encountered myself. What I'd like to do in this talk is to share with you some of my experience, but really focus on particular applications that I've been working on. So I have a list here of a few applications that I worked on, and they're already published in various journals, so I'm not going to spend too much time on them. I'm really going to focus on the last one. So the examples I've been working on for the last decade or so, first measuring, consumer behavior. So we mentioned that, web traffic, in-person traffic, looking at people, are they, they're searching for web direct for directions to go to a store, are they looking for store hours? That could give us some indication of their propensity to shop at different stores, the retail. So you can have measures like that. I created them myself. Sometimes I use third party. Sometimes seller information to see location. But at the end of the day, what I found, it was very helpful to understanding firm earnings. I was able to predict some earning announcements, and then I created some indicators, whether it's in person, again, online, and brand recognition, that all of them told me what consumers are how they're going to behave, and then you can forecast from earnings. Another example is uncovering relation between companies. What do I mean there? Well, we look at 401ks, 10ks of companies, and we can detect the relation between them. Because look at the competition section and you can see, oh, this firm is mentioning that firm, and you can build a network and you can better understand the competitiveness of a company. Like a company can say, I'm competing with Google, Apple, etc. But unless Google and Apple point to that company might not be a really strong competitor. So sometimes it's better, if you want to understand more about the company, look at what their competitors are saying about that company. So that's an idea of a paper that looks at scraping and data and all of that, and it shows that firms that are competitive in that sense end up being outperforming. Most recently, I think about a year ago, I looked at retail investors. We know given COVID, what happened, retail investors started trading more. We got some data from Robinhood to understand what retail traders are trading. We supplemented that with Reddit information, social media, started counting, the number of rocket to the moon, YOLO. I mean, it's a whole different, world out there. And with that information, we're able to understand when do retail investors, kind of together go in and out of different stocks. And that also has significant predictability. But what I would like to talk to you about today is understanding more themes and narratives. So the way I think about the use of big data in this context is to have better measures of what's going on out there in the world. And I'm going to use that to talk about something I call attention pricing. So what are the different narratives? I like to classify them into three. I mean, one type of narrative is just priced assets. Okay, we can talk about the stock market, particular stocks, Tesla, Twitter, whatever, metaverse. We can talk about these kind of priced securities. If we want to understand a little bit about them, well, at least we have a price, oil. There's macroeconomic variables. One of the things Alex mentioned, which I really liked, is, well, we don't have unemployment measures every day. We have it, on a quarterly basis or monthly basis. Same thing with GDP. So how can we measure what is going on with these variables between, announcement? And another type of narrative is just intangibles. How do we measure something like Brexit? How do we measure something like trade war or COVID or Omicron? Or shortages. How do we measure those? So the solution that I'm going to put forth here is we're going to quantify narratives by looking at media coverage. So in company that I co-founded, MKT Media Stats, what we do is we essentially create a replica of the web. And we organize the different digital data sources into different reservoirs. We have general press and we have corporate related articles and FX and political and any kind of reservoir that we think makes sense. We create it and we organize the data in these reservoirs. So it tells us how the media coverage, what it's saying about the narratives for each different reservoir. We're talking about 150,000 sources, about 2 million digital articles a week, and that gives us a good idea of, or at least it gives us a good reservoir to quantify the narratives. And how do we quantify them? When we look at the number of articles that talk about these narratives. And we start calculating the percent of articles that has of all the articles in a given day that mention this narrative. And we need to do a lot of adjustments. And Alex mentioned the biases in data. I'm not going to talk about that, but there's a lot of biases in media coverage. We need to understand who the source is, what their incentive to report. We do a lot of geographical biases. We try to correct for all of that. But at the end of the day, it gives us a nice quantification of what the narrative is. And that's going to give us two implications. One is going to tell us we can use that to try to understand if a narrative, if an asset is described in this narrative, does it predict its price? So that's one thing we can look at, price predictability. And another, we can try to understand how asset prices are reflective of different narratives because people have limited attention. So if let's say every day, there's only 5 things people can think about. Probably what's going to happen is that during that day, when you look at security prices, they're moving because investors are pricing them according to these narratives in their mind. I'm going to use that to try to identify price movements that are informative to particular narratives, whether it's going to be inflation, ESG, trade war, anything. I can use this method. So let me start by, first example, looking at some predictability. And what I'm going to show you here is monetary policy. How do we measure this? Like, what's the problem with monetary policy? The problem is there's two that in understanding monetary policy. There's at least 2 problems that I can think of when you look at official communication from the Fed. First is by now they know that every word they say goes through scrutiny. People, are looking and machines are looking at everything they say. So having known that, the feedback effect is they're going to be themselves be very careful about what they say. So at the end of the day, when you look at some kind of NLP to try to understand communication, it is so edited already that it's uninformative. It becomes opaque. Everyone is hedging. The other problem is they don't communicate every day. Even if there's 8 meetings a year and some special meetings, what happens between the meetings? I want to know what's happening every day, with monetary policy, but they don't communicate every day. So what's the solution? The solution we have is let's look at media. The media talks about inflation, unemployment all the time, even between announcements. So if investors don't have official communication during these days, during those other than the 8 days, they can go and look at what the media perceives the monetary policy to be. And what I'm going to show you that actually that's informative. So we can look at our reservoirs, take all the articles that talk about the Fed, and look at their articles and see which articles suggest that the Fed is going to be more hawkish, which articles are going to suggest the Fed is going to be more dovish. So which articles talk about interest rate hikes, they talk about quantitative tightening versus easing, and we can have a measure, let's say, hawkish minus dovish divided by the sum. So that number will be between 1 and minus 1. It will fluctuate. And the figure that you see here, you can see that here, if you can guys see, this is our hawkish dovish tone. So early on, right, let's say a few years ago, they were a little bit more hawkish. We can see that I plotted here also the 3 months treasury yields. Treasury yields were going up. And what's interesting is when the Fed started being a little bit more, or the media's interpretation of the Fed of the Fed actions is becoming more dovish. That's when yields started, dropping. So there seems to be some kind of a lead lag relation. Of course, we have regressions that we prove this, but just to show you how it looks like graphically, it seems that there's some kind of lead lag. Of course, at the end of the day, the rates dropped at the beginning, amid the pandemic, and since the I guess March 20th or so, last week of March, things have become a little bit more hawkish. So we can look at these indicators, the hawkish dovish indicator, on a daily basis. We calculate this actually per week, and we can see whether shocks to hawkish dovish, so changes in the indicator, does that lead to changes in the yield curve, okay, across the term structure. And what you can see, there's 2 lines here. One, this blue line signifies changes in hawkish dovish indicator over non-FOMC meeting weeks. So when you look in between the meetings, and the media seems to portray more, the Fed is becoming more hawkish, in the next 3 weeks, you're going to see the yield curves are going to jump up like this. And when you look at communication during announcement weeks, there's still a bump up, but it's much less pronounced. So I think this is a great example of showing that you can turn to the media when you're looking between events as a source of information that has some predictability. Now you can go even further. Why not look at the individual members? So we've done that. You can look at Jerome Powell, what the chairman of the Fed is saying, versus all the other members, and you have 8 governors, another 8 regional, and you can look at them individually. And of course, there's rotation; not everyone votes. And what you can see on the graph here in the top right is we plotted the disagreement in the individual members' hawkish dovishness indicator, disagreement over time. And what you can see, a high number means they all disagree. A low number means agree. And the bars that you see here, the lines signify the meetings, FOMC meetings. So you can see how things change over time. You can see here the cluster of meetings here, the special meetings right at the beginning of the pandemic. And what I think is really interesting is when the pandemic started, you see the disagreement dropped. Everyone understood, yeah, there's a problem. Everyone agrees what you should do. And then as things became better, and then there was a lockdown, people got out of the lockdown, then disagreement became more significant. Okay, signifying that it wasn't clear to people, even on the board, how you should react. So there was more disagreement. as you go forward in time, the disagreement has dropped. And I think that all makes sense. But these are actual quantifiable, right, numbers on a daily, weekly basis. You could look at take yields and regress them on the Fed tone that I've shown, the sigma in the tone, and also Powell's tone, independent tone. When you do that in the regression altogether, then you're essentially orthogonalizing the effects. And if you look at the total VAR that you're explaining, about 51% of the total effect that you're able to predict yields with the media, 51% is really the Fed tone, and then about 25% each between Powell's independent voice versus the disagreement across all the members. So I think this is just showing you, one example where you can use the media to understand, to better measure things like monetary policy on an ongoing basis. But why look at just monetary policy? There's a ton of different narratives and themes that we can look at. So this is a snapshot of a dashboard that we've built. And to give you an idea, the columns here are the different information reservoirs: FX, country equity, aggregate, financial markets, economics, corporate, general, international, politics, domestic. We have different reservoirs of all the media coverages. And what you have on the rows are different narratives: COVID-19, inflation, volatility, civil unrest. All of these have the highest intensity in the last 7 days. And this is as of just earlier this week, a few days ago, when I started working on this presentation. People are not talking about SPACs, short squeeze, pump up demand. They're not talking about that anymore. So it shows you, this heat map can show you what people are talking about. The key is understanding the time series. Because if you understand the time series, you can start calculating exposures, and you can understand better what, which stocks are more risky or exposed to the different narratives. The top graph here, I really like it because it shows you the information diffusion, how information is disseminated in the marketplace. What I have here is the narrative of COVID-19. I look at how many articles talk about COVID-19, but I have it for each of the reservoirs. And I thought this was fantastic. When you look at how the information propagates in the market, okay? The top line here is FX. These are the FX traders. They're talking about what's happening in financial markets. They were the first to talk about the COVID-19. After that, you start seeing that in communications of corporate communication. And only after that, you saw it in general press. And even further after that, in politically based journals. And when you look a little bit after, so this is the beginning of the pandemic, you look a month in, 2 months in, suddenly it became a political issue. Like politically, I mean, when you look at political magazines, political media, that, COVID-19 is completely all over there. So it does kind of suggest that it became like a political thing. So certainly in the US, it has been like that. So that, I think, is interesting to just understand, life cycle. There's life cycle issues and narratives. We look at a lot of different things on our dashboard. It's a few hundred different narratives that we've coded. On the bottom, I have something topical these days: inflation. What's the intensity of inflation? Are people talking about inflation? The answer is yes, but they've been talking about inflation a lot, and there's time variation inflation, actually much more than CPI. When you look at the last decade, right after the financial crisis, we all thought, well, we're printing money. Where's the inflation? Where's the inflation? It didn't happen. But there is a significant variation in the attention that investors gave to inflation. And of course, more recently, we're thinking about inflation happening in 2021, 2022. The discussion on inflation happened much earlier. So what we could do is, given we're able to quantify the attention of world press, which I think signify investor attention, to different narratives, I can then take this time series and estimate, with regressions, I can estimate exposures. I can estimate betas to inflation, or beta to COVID, or beta to trade war, beta to Brexit, whatever. And I can use these exposures to understand better, models for expected return for different assets. So let's dig in a little bit more into inflation. How do you build? This is a question we received. How do you build an equity index that is supposed to track movements in CPI, in inflation? Now, that's been a challenge for financial economists forever. What's the problem with that? You look at CPI, let's say you take a stock return, take stock return, try to regress on CPI. Well, you're not going to get much because it didn't really move much. Another problem, let's say you think oil prices or gold are related to inflation. Okay, so you can calculate oil exposure, so stock exposure to inflation. Take a regression and everything. We know how to do this machinery. You have 60-month rolling. You get the take stock return, regress on the market plus oil. You get the beta. You think this is a high beta high oil beta stock. What's the problem with that? Is that not all oil movements are due to inflation. Now they are, but a few years ago they weren't. And if there's an attack in the Middle East, suddenly oil prices go up. But it has nothing necessarily to do with inflationary pressures and everything else. So it's hard to just look at oil prices and gold and use them as proxies, or even looking at CPI as a proxy. So the solution that we have is to say, hey, let's use that regression to calculate oil beta, but we will also interact oil with inflation attention. So instead of having a regression just of stock returns on oil, let's also add an interaction term, oil times inflation attention. What is that going to do? That coefficient will tell us how does the stock fluctuate with oil when people care about inflation. So those fluctuations in the stock are more likely to signify how people price the stock with respect to inflation when they're looking at oil. That's the point, that you're able to, it's essentially giving more weights to periods that we think ex ante are more prone for people pricing the securities with that thing in mind. Because I'm a quant cross-sectional asset pricing person. I price stocks, thousands of stocks in the cross section. And in my mind, yeah, a lot of us do this. You take market beta, size beta, value beta, you look at yield beta, all sorts of different betas. And we're assuming that investors price all these securities with all the betas in mind. But in reality, I don't think that's the case. I think they price the securities in mind with a few narratives at any given point. So that's what we're trying to do with what I'm saying attention pricing. That prices are more inflation informative when inflation tension is at the highest. So in this model, what we do is we look at oil betas, but interact with inflation, and gold beta interact with inflation, and CPI beta interact with attention to inflation. And when you rank stocks, again, on a forward-looking kind of basis, according to the high interaction betas, and you pick these stocks, what you see here in blue is the fluctuation stock returns 10 minus the market. So you take the highest decile of this combined interacted beta versus the market, excess return. And you look at CPI changes, and you look and you see a beautiful, okay, biased, a beautiful overlap. So the correlation is very, very high. We can do the same thing for ESG. Alex mentioned, and I know a lot of other people, what they do is their approach to solving the ESG identification for different stocks, the E, the S, the G, is to go and look fundamentally, carbon emission, heat, whatever, supply chain, and look at, for each firm, how does this firm characterize in terms of being an ESG solution. That's one way. Another way is to ask the marketplace, what do you think is important for ESG? So how do you do that? You take the ESG narrative. In this particular case, to zone in, we looked at climate change. We look at discussion of climate change. Not every day people care about climate change. When there's when there's a conference, when there's a like the Paris Accords, people care more and they have their attention on climate change. So what we do is you run a regression, again, a forward-looking basis of stock returns. We did it with 52 weeks on the market return and the narrative where the media is saying about climate change. And then you look at the climate beta. What does it mean a high climate beta? It means the stock return is high when the discussion on climate change is high. So when people, the way I interpret it, and this controlling for the market. So the way I'm thinking about it is, when people care about climate change, some stocks are going to be priced high, some stocks are going to be priced low during that period. Those that are priced high, these are the high climate beta stocks. The market is telling me that they think that when climate is an issue, they think these stocks are going to do better. They're pricing these securities higher price, and some securities are lower price. If you take, we did here, the universe, and we used the MSCI ESG classification here. They have ESG leaders and ladders, and they look at particularly in carbon emission solvers. And when you look at that universe and you further sort stocks in that universe according to their climate beta, according to this market-based measure that I'm mentioning here, you do find that those that we are better, I think, identifying them as solvers, outperform those that are that the market perceives them to be worse off if climate change worsens. You can see that spread. So this is an alternative data, alternative way of understanding which stocks are more or less client friendly. And this is just by looking at what the market is telling us, that when they think about climate, they think these stocks are going to be the winners and these stocks are going to be the losers. Finally.
And Ronnie, a quick question. Did you compare that with the ratings? So do these winners or the high rated environmentally rated stocks, for example?
Yes, so that's a great question. So this ranking is among all those that are in that universe, and then when you calculate the correlation with certainly with the MSCI ones, the correlation is negligible. So I do think it's something different.
Mm-hmm.
And the nice thing, again, this unbiased, the nice thing is you can do it for anything. It's a different. That's why I call it attention pricing. I think it's really cool for the macros. I think it's really cool for ESG, but you can think about this in a greater context and a greater asset pricing context in general. You don't have to look, you can look at factors. When do people talk about value and size? When do people talk about momentum? And we've done it actually. You can run really interesting rotation strategies with factors according to when they're more popular. All right, so last thing I want to show you is, okay, you can take this and kind of do like a mega trend thing. You can look at every month. So this is again a snapshot of our dashboard. We look at what's trending in the media. What are people talking about? And this is just from we just updated this end of Jan, so just about a week ago. And when you compare the last quarter versus the previous year, Web3 is the most discussed. Then NFT, metaverse, COVID mutation, military escalation. I think all this makes sense to you when you see it. But the nice thing is it just gives you a huge cross section of all these narratives. And among those, these seem to be very top. When you click on one of them, right, you can see the list of names of firms that are these, according to these market-based measures and others. We use other things as well, but it tells you which stocks we think are the most exposed to each of these narratives. And then here you can see kind of a backcast of how that would look like relative to an index. So that is a rolling thing. And the nice thing here is I think it just helps people. It gives a solution to a particular problem of creating baskets about themes that are topical. Okay, so let me conclude. I think, you know, I'm fascinated with alternative data, and, you know, I'm not sure even how to define it. I just think it's whatever I haven't done before. So it's not price, volume, and all that. It's just different type of data, which requires different type of analysis, and we need to be very careful about how, you know, how we process that, how we use the data, and we need to be careful that the data is right. The use cases that I talked to specifically today are really measuring narratives. These are kind of intangibles. It's a word, it's a sentence, it's an idea, and we don't know how to measure it, but with the media, we can have a solution to how to quantify that on a daily basis. And if we can quantify, then we can calculate stock exposures or any asset exposures, and further understanding that attention pricing idea. And at the end of the day, we can come up with topical baskets. So I think there's plenty more to do, but I'm going to stop here, and I welcome your comments and feedback.
Yes, thank you very much, Ronnie. So you can ask your question in this chat or raise your hand. So thanks for a fascinating and very insightful presentation. I would like to start by asking you a question about your definition of a narrative. So if I Googled the definition of a narrative, it should be a spoken or written account of connected events. And that was the definition I had in mind, right? That and Pierre later on will talk about causality links. But it looks like in your definition, narratives are more like news, right? You're not trying to assess, for example, microeconomic factors that would be connected with stock returns. I mean, you're doing that ex post, but you're not trying to identify in the press what are considered, what are the type of information that are considered to be causal or at least related to a given fact. Am I correct?
Yeah, so I think you could think about this as a theme, but I think it's more than a theme. That's why I call it a narrative, because a theme is something, you know, it's a noun, and with our approach, you can actually code this to be an idea. So, and in addition, I think a theme is something, it's kind of more neutral, where our approach does a lot of corrections for biases that I didn't really talk about in the interest of time, but we do try to correct for even like an author fixed effect, right? I mean, the Wall Street Journal is always negative. You need to understand. So I think by using the word narrative, and you know, many of you might know this book I was carried
Yes.
with me here, you know, Bob Schiller, who I presented with at the State Youth Conference a year ago. That he came and presented, and then I came and presented. Here's how we can actually measure it and use it. And his definition of narrative is as kind of as you said, but a little bit different. It's something like, you know, do people is the narrative the idea that house ownership, that people need to own a house. It's like an idea in their mind, right? So he gives this example. In his life cycle, the narratives could be multi-decade, right? So I think about it as themes, but it's not themes. It's just a simple. It's too simple to describe what we're trying to do. And given all the customization that we can do, I really think that narrative is probably just more appropriate. But I think yes, you understand exactly what I'm trying to do here. Yes.
Okay, that's great. So we have another interesting question in the chat. In terms of attention, how do you, by Michel Curec, how do you get the appropriate labels? For example, I see NFT or robotics. Why a term like quantum technologies is not appearing? So how do you select? Is it the more frequent words that you find in the press? So how do you select these narratives in in the first place?
Yes, so there's a few when you talk about narratives and emerging narratives, there's a few ways to think about it. First, there's those that are that we code, let's say, that are pre-coded in the sense that someone comes and say, hey, what can you tell me about you know, shortages? And then you start looking at, well, you know, supply and labor shortage, and what kind of different words, or the monetary policy, what are the different terms that would be associated with that? And then we program that, and then we choose one word to describe it, but there's a lot of other words and terms we use to identify. Then there's another question of how do you detect emerging themes? And that's something we do. I mean, it's not completely systematic. It's, I would say, like semi-automatic in the sense that at the end of every week or month, we kind of look at the data, and it's not exactly a TF-IDF that you look at the words that are the most. we have some other techniques, because just looking words is not always, and we look at, like, as you mentioned, like cluster of words that mean the same thing. And then that's why I call it semi-automatic. When we see that happening, we're going to call it a term, like NFT 3. But there's a lot of, it's not like NFT is not just looking for NFT or, non-fungible token. It's just, there's other things we look for. And that's why I'm saying semi-automatic, to try to get better identification. So
Okay.
it's good to differentiate between the pre-programmed ones and those that are emerging. And those, once they're emerging, they go back, to the they go back to those that are pre-programmed, and then new emerging come out, every month.
Okay, thank you. And maybe I can ask a last question from Azer Mimouni in the chat. How robust are factor universes that are built on correlation between trends and stock returns? Do they need frequent rebalancing?
Look, I think, it's going to be, the answer is going to be yes, but I think it's going to be as frequent as your investment horizon. So I used to be much more of an intraday, and I've been pushed to doing things longer, like less low frequency. When you think about the more institutional side, they, maybe a quarter, maybe a month, quarter, something like that. So we design our models to be as frequent as, as one would hold it. Typically, if the holding horizon is like a month or a quarter, we look at regressions that are done on a quarter, with quarterly or monthly observations, and we kind of rebalance that over time. If you do that every quarter with 60 months, there's going to be a natural natural half-life of that signal.
Yes.
But for your question with the ESG, I can tell you that they're much more stable than what the model would mechanically produce. So even if given a year, you look at what the ESG score would say, and then you take a non-overlapping the next year, the correlation between these two is going to be pretty high.
Thank you. We need to move to the panel because we're already running late, but thank you very much, Ronnie. And Alex and Ronnie, if you can stay with us in the panel, that would be great. So I'm going to ask Charles Albert to join and his panelists. So Charles Albert, the floor is yours.
Thank you. So, and thank you for the two speakers for the very interesting discussion. So we will move to the panel, and they will be joined by Ghislaine Amrani, excuse me, Ghislaine, co-founder and CEO of QuantCube Technology, with Pierre Arène, with CEO and co-founder at Causality Link, and Eric Lebigot, who is head of data sourcing at CFM. And so maybe just to introduce this round table, what I can start with is that when all this debate or topics around alternative data emerged, the question I try to ask to myself is, what will be the different? What will really be different? Because after all, we are working with data for long, and what could be qualitatively different? And I think that we had somehow an example. And examples here during the first two talks. First, you saw with the first discussion by Alex that there are so many data that you can have access to. So now it's not about working on a given rectangle of data with prices, volume, and so you oscillate around that, trying to find new techniques or portfolio constructions. Now only the imagination is your limit. If you want to count the napkins that are sold in each hotel room in each big city because you believe that it makes sense, you can do that. And now you need to go to economics. So for systematic people and quantitative people, it's an open door to something that is more an economic thinking. And for people who are more discretionary, it is exactly the reverse. Because as we saw with Ronnie's presentation, with these indicators that can be built, now even if you are a discretionary asset manager, you need to take into account all these kind of indicators, metrics, and analytics. So there is something that is a merger where when you were a systematic asset manager, you need to change your mind and to think about the common sense and the economic sense of what you are manipulating. And the reverse is also true. If you are a discretionary asset manager, now you need to think in terms of quantitative and analytics. And for me, this is really the disruptive aspect of that, and it is what we will talk about today with the panelists. And so to introduce the panelists, I think there is a very obvious question. So I've been very lazy on that, is what is your definition of alternative data? Because we had a lot of oscillations around that. So maybe we can start with Ghislaine.
Yes. Hello, good evening, everyone. I am Rizlan Amrani. I'm a COO and co-founder of QuantCube Technology. So for those of you who are not yet familiar with QuantCube is a company specialized in real-time economic intelligence by analyzing alternative data. By real-time economic intelligence, we mean that we deliver leading economic indicators to our clients in order to help them to leverage on the asymmetry of information. And what makes our approach really unique today is that we have a fundamental based approach. We rely exclusively on the analytics of alternative data. And we have a multi-data source approach, which means that we never rely on one single data source to generate one output, one signal, one indicator, but we cross multiple data sources. To get back to your question, Charles Albert, within QuantCube, actually, we have maybe one of the largest data lake today. We are really proud of that. And the way we define alternative data is that we have categorized this data into 4 main categories. The first one is textual data, of course. I mean, Alex has explained a lot of that during his pitch just before. So textual data is social media, of course. It's related to news, blogs, but also job openings data. They are really quite unique data sets. We gather them directly from corporate websites at a company level. After that, you can aggregate this data at a sector level or even at a national level. And it's data you gather in different languages with the wide coverage. The second category of data is what we call geospatial data. It's mainly related to satellite data. And it's all type of satellite data. So it can be, of course, images, but not only. It can be radar data, and most recently, atmospheric data. Very useful for ESG applications in order to measure the level of emission of different gas and pollutants in the atmosphere. So we have the example of Sentinel-5P, which is a European satellite launched in 2015, which is mainly used today for those ESG applications. The third category of data is related to geolocation data. So we have mentioned before AIS data for shipping industry, very useful to have leading indicators on the international trade or even commodity trade. You have also data related to telco data that can be mobility data, and of course air traffic, which was very useful before COVID, but right now it's not the right data set to look at. And to conclude, the last category is related to structured data. It's all types of data that you can gather by yourself. It can be good prices in order to compute your CPI index, prices of vegetables, of clothing, and whatever. It can be corporate loans data. So it can be all types of structured data from sensors as well that you can gather by yourself. So this multi-source approach is very useful, and it's really part of our methodology because it enables you to have a high accuracy of your outputs at the end of the day, but also to avoid sometimes some misleading interpretation whenever you rely on one single data source.
Okay, thank you very much, Ghislaine. Pierre, what is your definition of alternative data? You need to unmute your, yeah.
To unmute button. All right, should work. Yes. So first, there is 2 types of alternative data. The first type is the numerical data that creates time series, and we've talked a lot about it. And the other type is and we call that the signal. And we have, we have something that's very similar to Ronnie, and I'm not going to go too much more into detail on the signal. But the second part is what we call the model, right? So up to this point, knowledge graphs and things like that had been manually curated, so they were very small. And we are automatically extracting from text today 44 million elementary causal links that are relationships that have been explicitly stated in text between 2 elements of the signal that we just talked about. And so that can be, for example, things like Volkswagen closed a plant in some place that was producing Jettas due to chip shortage, and we understand chip shortage, not shortage, but shortage of the industry chip, because there are shortages in many other things in the car industry. We understand that Jetta is a car from Volkswagen, or if it is, and that they closed the plant, and therefore that the production of Jettas, therefore Volkswagen is going to drop. And we understand the relationship, the causal link between the supply chain shortage and the closing of the plant. And so that we believe is and that becomes data that can be manipulated, and then you can create, like what we did with Alex, automatically Bayesian networks that will propagate probabilities from drivers to targets. So to us, alternative data is going to explode in the structure direction, that is in the direction of the knowledge of the why, at least, which is what we extract, but through knowledge graph, a knowledge of all sorts of relationship between pieces of data.
Okay, thank you very much. And Eric, your definition of alternative data?
All right. So yes, coming from at least I can give the perspective of a quantitative and systematic fund. But more historically, right, the data that is the most obvious is financial data, like prices. So alternative data is naturally what is not this, at least for finance, what is not directly financial. We mentioned, Ghislaine mentioned many different types of data. And also Alex, or satellite, shipping, whatever, everything goes indeed, like Charles was suggesting earlier. So it's a bit like big data, right? So a definition of big data, one of the many definitions, is that it's just too big for traditional approaches like single computer memory. So alternative data is basically for us any data that allows in creative investments based on something that's less obvious, like Alex was mentioning, less common data. Less common
Perfect.
by finance.
And Ronnie, what is your definition?
I'm not sure I have anything to add there. I think it's all.
Okay, so we can ask to Alex, because Alex wrote the book. So
Yeah. I opened the talk with the definition. I presented the slides already, so I risk of repeating myself here. But no, I agree with what the others said. I concur.
Yeah, so with all these data, I think that are very diverse, and exactly like the definitions can be diverse, or the classifications. The second point is what to do with this data. And indeed, it happens that, but you will tell me what you think about that. But there are two somehow different ways to use the data. Something that is closer to nowcasting, that is what you can do with inflation when you are counting or just collecting a lot of data about prices. So you do something that is just a reconstitution of the world. So you've got sensors, and you just want to understand better the world. So it's really nowcasting. You just understand what is happening currently under your eyes. And the other part is more something that is about asset pricing. So you want to predict. So you want to capture things that make sense from a financial perspective. That is somehow only what you presented. So trying to use alternative data to anticipate something that should happen on financial instruments. So what do you think, each of you, that could be the first usage of what you see being alternative data, and the kind of alternative data that around you people are using? So Ghislaine, if you want to start.
Yeah, well, the main usage in general, to give you the big picture of what you can do in terms of application with the alternative data we are sending to our clients, is mainly that those data are really helpful to detect regime change. For instance, if you take the CPI, the CPI nowcast, and you cross it with the leading economic bureau nowcast, we can really detect the change of regime. It's really helpful also to detect trends, turning points, acceleration, decelerations, and also to determine the risk mode. Either is it risk off, or risk on. And the risk off, risk on mode, the way we compute it here internally is that we take the leading economic growth of the US and in China, and you compute the maximum of it. And if this maximum is strictly positive, you are in risk on mode. And if it's negative, you are in risk off mode. And it is a very nice tool for market timing, but not only. It also helps you to detect all financial market drawdowns. If I take also, maybe I can make a distinction between systematic hedge funds clients and discretionary clients. For the systematic clients, the main application will be around asset allocation, sector rotation, fixed income arbitrage as well. And if we take once again the example of the risk on, risk off mode I just mentioned, the way they use it is whenever you are in risk on mode, they will directly invest into cyclical sectors. And if you are in risk off mode, they whether invest into treasuries or into defensive sectors. Another example of a systematic investment use case can be related to credit. So if you detect an acceleration of the economic growth, therefore you will invest in high yield grade bonds. And if you see deceleration, you will rather invest in investment grade bonds. So this is how it is mainly used by systematic clients today. For discretionary, it's difference. They will mainly try to identify the trends, to try to find out the turning points, the accelerations and decelerations. As an example, our client were able to see the acceleration of the US inflation back to actually November, back to mid-November, before the publication, 3 weeks ahead before the publication of the official data, which gives them a hedge. And also, if I remember well, during the COVID crisis, we were able to see the bottom of the Chinese industrial production back to April 2020, thanks to our solution on satellite data analytics. So if I have to summarize in terms of usage, I would say that our systematic clients will mainly look to our data in order to generate and to extract alpha out of it. And for the discretionary clients, they will mainly try to use it to identify the trends, the turning points, the acceleration and decelerations.
Okay, thank you. So, I mean, naturally, probably the discretionary asset manager are more looking at nowcasting somehow because they just want to, they want to understand to then take their usual way, take decisions the usual way. But the systematic asset managers, they need to have like signals, something that is more predictive. And so, Eric, is it, can you confirm that the way in a systematic hedge funds alternative data are using are more towards building signals and predictions rather than nowcasting?
Yeah, the situation is kind of mixed because one of the things that we used to hear a lot about alternative data or data in general is that it's the new oil, right? What do you do with oil? You power your motor, right? And so one of the big ways of using alternative data, at least for us as a systematic fund, but it's not restricted to a systematic fund, is really to have advanced indicators of anything, right? We mentioned inflation, it can be rates, whatever. So it's really, data is really the fuel for getting advanced information on the economy. And then as a systematic fund, we can do many kinds of regressions and models to find the exact prediction mechanism. So that's one thing. Another thing that I must mention here is that, of course, what is specific to systematic funds is that with the data can be, when the data is analyzed by computers, you can analyze, of course, millions of texts and apply that to thousands of stocks. So here, that's a difference with discretionary funds that I can mention. So that's what I would say.
Okay, thank you so much. Alex, what is your view about that? What are your views? More nowcasting or prediction or asset pricing? I think you are muted. Yeah.
Can you hear me?
Yes, now we can.
Yeah, I think bandwidth in the CPU is too busy crunching alternative data now. Let me stop some of the processes, but I think the ultimate goal is always forecasting. So you now cast to forecast, even if you're discretionary manager. Nowcasting gives you insights, in your decision engine, in your brain, the cause of Bayesian maybe you built in your net, you use this information to make a judgment. And if you're discretionary manager, you have to deal with the future as well. So you need somehow to forecast, but it's done in a less systematic way. So we're lacking that quantitative component. I think I showed in one of my slides. It's that first you nowcast, then you take the nowcasted variables and you put them in a predictive model. So there is a chain of models. But I think the ultimate goal is we nowcast to forecast, to take a decision based on this. An extrapolated trend, or as Ghislaine mentioned, is the tipping point, the trend in credit space. So you always think about the future. But there are two different steps, the one you do when you're systematic and when you're discretionary.
Maybe there is also something like, because here we are talking about data and about models, but not about theories. And somehow, if you want to, if you want to have a little hope of generalization, maybe you need to build a theory. And maybe with alternative data, instead of focusing on an anecdote, because it's easy to build a narrative on two curves. But now, if thanks to alternative data, you can derive these curves in all the regions in the world, in maybe local, to understand a little bit better what happens. If your theory continue to be true in a given region 20 years ago or 5 years ago, I'm thinking about, for instance, the oil crisis in Texas. It was recent enough so that with alternative data, you really could observe all that is happening at the scale of a crisis within a small country. And so you see how people are losing their job, how the credit cards are no more used, how the employment is rising, how the real estate is moving. So now you can build a theory. And maybe because of that, when you build a model, it's no more just a regression. The model can be an explanation of the world because you put a lot of experimentations in front of you, because all these alternative data can give you a picture that is not too much aggregated. And also now you observe a lot of small experiments that become independent somehow. Otherwise, you just observe one big experiment that is the US market globally and nothing else. I don't know what you think about that. If it could maybe expand the domain of the of the experimentation in an economic sense.
Who is the question for?
I think it's for you.
Yeah. I think Pierre has much more to say on this, but I agree with you. If you think about systematic few factors strategies, and this was being used up to now, but you gave me food for thought, Charles, but I even took notes for what you're saying. But a narrative is a point in time, according to you. So every time you have a different context. So you have something that's not repeatable, but nevertheless is important. So for example, I'm trying to look for, we have a upward pressure in PPI, purchase price index, which is a leading indicator for CPI. But we are observing values never observed in the past. And I have to predict inflation for one country. I was given this project now. It's very difficult to define, to understand the context, because this never happened in the past. So you have to build one-shot narrative, as you say, in that particular region to understand how different drivers interact as of today, how the market see them going forward. But it's a completely new set of modeling. It's one of Pierre is shaking his head, but I kind of agree with your approach. How to build a narrative that's point in time. Instead of building a model that outputs a number, maybe build a narrative.
Yeah, but look, if you extract from the text of smart people trying to shine by publishing, which all of you are, if you extract the explanation that they give of the why, and of course you extract the countries to which they apply and all the context, it is possible to have completely different causal models by different countries, which we can generate very easily. We generate in Kenya, for example, we see that the emergence of the drought that creates a food crisis, the increase of crime, and is completely different than what happens in Tanzania and of course in the US or in China. So I think that there is an incredible amount of wealth in the causal explanations given by smart people in text, and being able to extract that enables you to have a daily varying causal model that that is a factor universe that is not built on correlation, but built on smart people explanation aggregation. And I think this is going to have a big, I fully agree with Ronnie, but so Ronnie finds the correlation after the fact. Well, I think if you dig deeper in your text, you can find the correlation before the fact, because a lot of people are able to explain correlation before the data shows the correlation. This is the beauty of the human brain and of experts.
So Ronnie, can you follow up on that?
Yeah, I think yeah, I mean, I guess my reaction to Pierre is that on the one hand, you can think, here's the way I'm thinking about what I'm doing. Part of it is what Pierre said. Part of it is you don't want to be the only right person in the room. In other words, the market might be wrong, but I want to know how they think. So in that sense, if security prices are, so the market-based measure is saying, here's what the market, it might be the market is wrong, but this way you're capturing how the market feels about this particular, narrative or aspect or whatever, or link. So I think that's just something that I like trying to think when I'm running these results, what am I really capturing? It might be that I can be smarter if I do a more causal approach, but then I might miss on what everyone else is thinking. So I think it's an interesting discussion. I'm not sure what's. I mean, they're both valid, of course.
I'll give one little example. So yesterday I was with a head of a fund that is very successful in commodities, and at the end, the founder and head quant said, "Look, this is the way I think. I have a forecast on different factors, and my brain is the Bayesian model that says at the end of the day what direction the commodity is going to go." The funny part is that we talked to him because his quant had been running our forecast model, and which forecasted very well the data. So somehow there is that's to answer the question of Charles Albert. There is a blurring of the difference between explainable models that run for quants and the way advanced discretionary traders think on very focused areas.
Well, what I like about Pierre's approach is that what I'm hearing is that Pierre seems to think about the economics first. And a lot of the discussion I've been hearing, there's so much data now, we really need to be worried about overfitting. Because God knows we have so much data, we'll be able to fit something. So I think thinking about like these causal links, I think as Pierre says, makes a lot of sense, because you need economics. I think that's what Charles Albert said. You need economics to guide you, because otherwise you could be really fooled by the data.
But
yes, exactly.
Pierre measures what journalists consider being the causal links. So, and then there might be also a difference between that and the real causal links in the economy, right?
Well, Pierre only looks at the smart journalists.
No, I think that in both cases, I mean, nobody exactly knows what is the perfect approach, but what is important is regularization. Mm-hmm. And you can make this kind of regularization because you want to maintain an economic rationale, so a model, something that really is transverse to all the models that you are building that make an economic sense. In fact, it's a large constraint, and it's a regularization from a machine learning perspective. Or you can say, indeed, I will not focus that much on prices, and I will try to have a consistency on a very wide corpus of text. It is more or less what Pierre is explaining to us. And now the fact to extract common causality, somehow common links that diverse people are thinking simultaneously. And it's also regularization, because the fact that you want to see that not only once, but you want to see that consistently without looking at the prices. It is a regularization. So the more constraints you put, the better. Indeed, when you've got a lot of data, and it's exactly what you said, Ronnie. And so I think that each of us will try to find the best way and the natural way for her or for him to regularize. But it is what we want to do. Either you if you are an economist, you say, okay, I want to have this kind of economist consistency. Either you are someone from simply machine learning at the opposite, and you say, okay, I do a brute force, regularization like pruning or something like that, or penalization by simply Nakaike criteria or things like that. So, but the important point is not to overfit. I think we all agree on that. Because the menu is so, what happens with alternative data is that the menu is so large that you can pick up any curve to match any other curve. It's just a matter of having a computer.
Yeah, and it's totally, I agree with you, and it's totally key. And this is why I mentioned at the early beginning when I said that the approach is fundamental based, because crunching data, at the end of the day, would not work and would not be consistent, definitely. The way we look at the data within QuantCube is really fundamental approach based. Once again, we look at the supply and demand factors. We try to find out the main components that explain the variance of all the parameter we are looking at. And this is really important because once we look at the data, we go to it with a very targeted approach, and we're just not trying to crunch data to find out different types of correlation or whatever. So at the end of the day, it's important because we can explain what we are gathering in terms of outputs, the signals, and of course, it's point in time and consistent over time as well.
Yes, it's very true.
Yeah,
Okay, so maybe we can open the. Excuse me, Eric.
Yeah, maybe I can just comment quickly. It's some kind of a paradox because we're getting richer and richer data, wider and wider, very broad, as you were mentioning, Charles, earlier. We can check many things in the data, what happens in whatever, UK, US, whatever. But at the end, the models cannot be too complex because there's too much information. So it's otherwise we can indeed overfit and predict very badly predict the future. So it's a very difficult exercise, right? We have this wealth of data, but we have to restrain ourselves with this regularization, simpler models, and that's a difficult exercise. But what we can do though, and that's maybe an interesting road here, is that with rich alternative data, we can build relatively simple things. Pierre builds causal relationships. We can put companies together based on text and things like this, and then on this apply relatively simple models. So we can use the richness of all this new data coming in to build rich but relatively simple things like networks of companies and things like this, and then build relatively simple models. So it looks like it's an interesting approach, a way of using the wealth of data we're getting now.
Yes, and moreover, I think that this question about using a lot of data but not too much, somehow it was there before alternative data just because of non-stationarity, and of course when you've got the world is non-stationary. So if you take, if you want to have enough data to have a low variance of your estimator, you take a very long history. But if you take a very long history, now you take you average over something that is not stationary. That's not good. With alternative data, what you can hope is that you increase the number of dimensions, and now because of that, you can go. You can compare things that are in different configurations, but because you've got more descriptors of the economic situation, now they are close in this state space that you are describing. So somehow it's also a way to stationarize the data. Okay, you can just imagine that you've got a data that goes around a circle, but you don't know. So you want to make a linear regression, and you just have access to, to explain the circle. And it's not really possible with a linear regression, except if you've got access to the multiplication of x and y. If you've got access to a third variable, that is the multiplication of x and y, and you've got also access to x squared and y squared, now a circle is just a linear regression because it's a linear combination of x squared, y squared, xy, and the constant. So, so indeed, when you increase the dimension, you've got access to a description of this of the world that can be explained very simply. And maybe the hope that in alternative data is that increasing the description of the economic state that you've got, now you've got indeed you've got access to more data, in the sense that you can compare what happened 2 years ago with what happened today, because you know that the COVID was not there 2 years ago, because you've got alternative data to describe what happens with the COVID. If you don't have access to this kind of alternative data, you've got no hope, in the sense that you just have prices, and prices are not telling you anything about the COVID.
Yeah, but
Charles
COVID,
Albert, yes, I would just like to mention that there are a few questions in this chat
Oh,
about
yes.
the IT infrastructure, and also it's very close to 7. So if you could maybe address these questions about the infrastructure necessary, about the carbon footprint, and then maybe wrap up, because we need to leave a few minutes for Adina.
Okay, yes. So about the infrastructure, I'm not an expert indeed. So I will let you really comment on that. Maybe Ghislaine or Pierre, you are more familiar with the setting up impressive infrastructure to digest your
no,
data.
I would say that so for example, we translate 27 languages into English, then we parse English. This was impossible a few years ago, but the cost is dropping tremendously, and I'm sure that AWS is making a profit. So somehow the electricity costs, computational costs are dropping at a rate that is very rapid. And I'm not talking about neural networks. I'm talking about let's say more natural language processing alternatives.
Yeah, I can give the example of satellite data. I mean, satellite data are really the heaviest data sets that you can have, and you require a huge computation power in order to analyze them. So yeah, this is definitely an issue. We have different cloud providers. As Pierre mentioned, the cost of data infrastructure and data storage are going down, which is actually good news for us. But definitely it's a challenge. We have sometimes actually also for our NLP algorithms using some modeling. We use sometimes BERT, and sometimes in order to process some data sets, we spend 15 days actually to run a model. And so yeah, it's definitely a challenge, but the cost is dropping definitely. But the carbon footprint of all this computing power and all this technology, definitely, I think, is not very good news for the planet. So we need to find out different ways to run the business.
Okay, so it's an excellent conclusion, I think.
So shall we give the last words to Adina, because I think Adina wanted to stress about the ESG issues, so that's a good transition.
That's perfect.
Yes, thank you very much. Thank you, Marie. Thank you all. So thank you for the two sponsors, the academic speakers, panelists, and moderator for a very insightful webinar. Well, you've touched upon a more and more important challenge faced by the asset management industry, which is the data. Making informed decision at the right moment is our business, right? So market participants are increasingly relying on data. So beyond financial data, which was historically the thing we do, we also now need ESG data. This is increasingly important for us, but also for investors and even citizens. So this is asked by investors because, as you know, asset managers work on an agency model. This is progressively integrated into our regulation. And of course, it is to make our contribution in the ESG space and, for instance, address climate change challenges and define and quantify paths alignment with the Paris Agreement. And these are very important issues that we have to address collectively. So well, one of the issues I would like to mention here is that, of course, we need raw disaggregated data, data with quality and which is robust. You can see there are large discrepancy and gaps in data sets. For instance, IOSCO has very clearly mentioned that, for instance, if you take ESG ratings, this is large discrepancies between agencies, but when you take credit ratings, there is low deviation. So finally, how integrate into the price the ESG characteristics of the companies we invest in. So ESG data becomes mainstream. Sometimes even it becomes regulatory data, for instance, taxonomy, alignment data, etc. So it's a question of price. You have touched upon it. There is a business value of data, and I totally agree with this. And in addition, regarding the alternative data, not everyone can buy all types of data. So it is also a question of accessibility. And I would like to mention the ESAP, the European Single Access Point, which is important for us. And so this is for, I would say, regular data and beyond. I think there will continue to be need of alternative data, as you have all of you shown tonight, because this gives informational advantage. For example, I would give one that you haven't touched upon is the need to screen media sources in order to identify companies involved in controversies, because we have recent examples of that in France. So acting on this information before the event happens, it is crucial in order to help portfolios performances to stay on track. So to wrap up, I would say that there are opportunities and challenges in the use of alternative data. There is value added, you have shown it, but there is also the need for in-depth due diligence around the production, the testing and model risk, the legal questions, the regularization versus overfitting and overcomplexity, the continuity versus obsolescence, the logistics and time consuming, as it has been said. So it is still creative. The sky is the limit, as you said. So I think and we hope that this ILB FaIR and AFG webinar has been useful to give insights on the current and prospective use of alternative data in asset management. Marie, Guillaume, back to you.
Thank you very much, Adina. I think we see here that we need another session on alternative data with a lot of questions which still need to be solved and discussed. So I would like to thank you all for your great discussion, great presentations. I really enjoyed the event. So we see we would need more time to do that, but thank you very much. I hope you liked it. The webinar should be, the replay should be available on the website for those who could not attend fully. And see you all next time. Bye-bye.
See you.
Bye bye. Thank you.
Thank you
Thanks
very
to all.
much. Thank you. Bye-bye.